Has anything changed in your views over the last few weeks on inflation, where rates are going, or any of that?
Everything's changed.
I'm becoming more convinced we're not going to see rate cuts this year.
No, I agree with that. I mean, maybe in the last quarter, but certainly nothing imminent.
Hi everyone, welcome to Bits and Bips, exploring how crypto and macro collide one basis point at a time. Today we'll talk about consensus 2025, Trump as usual, some news around Coinbase, some news around Circle, the stablecoin bill, which is the biggest news of the day today, and then also we obviously have to get into the U.S. credit downgrade by Moody. But first, some quick intros. I'm your host, James Seyffart, TradFi Archmaester, Lord of Bloomberg's End. I'm here with Alex Kruger, Macro of House Asgard, Protector of the Realm.
Hi, everyone.
Also joined by Noelle Acheson, High Seer and Keeper of the Crypto is Macro Now newsletter.
Hello, everyone.
Finally, last but not least, Ahluwalia, Maester of Wealth, Leader of Lumina.
Good afternoon.
And a last second, happy belated birthday to Ram, actually.
Oh, thanks, appreciate it.
Happy
I stopped
birthday,
counting the years 5 years ago, but Brian Johnson now, I'm going to do reverse aging, hopefully here on out.
We're here to discuss the latest stories in the world of crypto and macro. Just remember that nothing we say here is investment advice. Please check unchaincrypto.com/bitsandbips for more disclosures. Before we begin, we're just going to take a minute to hear from the sponsors who make this show possible.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing. Big news. Unchained just launched a brand new newsletter, Bits and Bips. Just like this podcast, it's all about how crypto and macro collide, one basis point at a time. Get expert analysis, market insights, and the biggest stories shaping both worlds, straight to your inbox. Subscribe now for free at bitsandbips.beehive.com. That's bitsandbips.beehive.com. Find the link in the show notes.
First thing we have to do is, one, it's always nice when we have just a round table of 4 of the 6 of us who are the recurring guests. So this doesn't happen all that often. We usually have guests, which are also great. But let's go into the biggest news, the Moody's downgrade. Let's go to Noelle here to give us the background, because we were talking before we even went live here. And there's some disagreement a little bit, but I think that like 90% of it we agree on. But let's hear from Noelle here, and then we'll get into some conversation.
Well, the big story is that on Friday, after the stock market closed, Moody's, the rating agency, announced that it was officially downgrading the credit status of U.S. government debt. Now, this is not a surprise. For the details, it's downgraded now from the pristine level AAA to AA1, which is one below, still pretty good, but not the pristine level that people expect when they think of the world's risk-free asset. It's not a surprise, as I was saying, because Moody's said back, I think it was in 23, that they were putting this on a negative watch. So in other words, this was coming. Also Standard & Poor's, S&P Global, I should say, they downgraded in 2011 and Fitch downgraded in 2023. So the U.S. government debt has not been pristine for some time. Now, what we were talking about earlier was, does this make any difference to markets? Fundamentally, not much has changed. 1, because it's largely priced in. Again, not a surprise. 2, because it's not going to change who can buy U.S. government debt. That big move was back in 2011 when S&P downgraded. Those that could buy U.S. government debt last week can still buy U.S. government debt. Where it does matter is whether they will actually want to. My view is that while fundamentally not much changes, the messaging here is important, especially given the timing around the debates on the tax bill.
Who wants to jump in next? Ram, any grand thoughts on the Moody's downgrade?
I think there's notable to call out that the rates actually tightened today after the downgrade. Now, there are technical constraints on certain managers that can't buy AAA rated debt. So when it loses that AAA rating, then they may have to seek a revision to their mandates to permit them to invest in U.S. grade debt. That's 1. 2, this is because we have 8% deficits. We have wartime deficits that are running, and we haven't seen any austerity. We haven't seen any belt tightening. The budgets that have been proposed just are increasing spending overall. That's bullish for markets, bullish for the economy, to be clear. but it doesn't help the debt to GDP picture. So it's politicians kicking the can very predictably. Once again, it is bullish for digital assets. It's bullish for a number of digital asset names. I know we'll come back to that soon. I think a very interesting question is, where do rates go from here? And I'd love to get the perspective of folks on it. On the one hand, you've got continued disinflationary forces, which you see in improving inflation prints. On the other hand, you've got a weakening dollar and the prospect of tariffs. And, Trump over the weekend said Walmart should, quote unquote, eat the tariffs. So you've got the prospect of that potentially impacting prices. And on the social media, Twitter sphere, there's a big debate on whether rates are going to 5% or we're topping here. Both sides have a lot of conviction.
So let me say on Moody's first. I mean, this is kind of like, it's backwards looking, but anyway, I was expecting on the news 50 bips to 1% move on the S&P. I think we got a little bit more, and really thought and still think it's a 1 day thing, because as Noelle said very clearly, it doesn't affect who can buy, which means it doesn't affect contracts, which is something that actually happened somewhat in 2011. And there was changes in how contracts of basically sovereign swaps are written, that they don't include credit scores any longer. So there's been no impact in who can buy. And it was in fixed income circles, it was widely anticipated. And furthermore, it's a third agency to fall in line. S&P in 2011, Fitch in 2023, and now Moody's. So it's kind of like a non-event. It is a non-event, just a 1 day thing. The 2011 one, by the way, was it triggered a very major market correction. 2023 was going to be, the way I see it, is it was meant to be a non-event until basically it was picked up by Ackman, who basically triggered one of the most incredible things I've ever seen in the financial markets, which was basically Ackman moving the treasury market as if it were a shitcoin. It was incredible. And let's.
I want to push back on the idea that this would be good for crypto. I mean, I'm personally bullish, as you all know, but there is a scenario in which maybe this is not good for crypto. And that is if indeed this does maybe not trigger a correction, but encourage the continuation of the correction that has been building, except for the rally that we've seen since the China agreement. So if there is a correction, and Alex is totally right in pointing out that the previous two downgrades did trigger a correction, this time is different, then arguably crypto short term would follow the stock market down. Why would it do that? I mean, hopefully Alex is right and it's just a very short term thing. But what if it isn't? Because the last two times we didn't have sovereigns exiting U.S. government debt market anyway. Sorry, by sovereigns, I mean foreign buyers. We got the foreign buyer report from the U.S. Treasury Department on Friday, which showed that in February and March, foreign buyers actually accumulated more U.S. government debt than in any other 2-month back-to-back period in decades. But that was up until the end of March. In April, we've seen the exodus of foreign buyers from the U.S. government debt market. And this is just another excuse for them to continue to do so, yet another justification to their clients or their bosses that this is the strategy to continue with, which is why I think that fundamentally this is a nothing burger. But in terms of messaging, it could have some impact. If we do see yields go up, which I expect, then that should impact stock market valuations, even if just earnings and the valuations of discounted cash flows, which I know are an old thing, but they do matter. When the yields go up, stock market does tend to wobble. And if the stock market wobbles, then crypto tends to wobble too, at least short term. We saw in the banking crisis in 23, crypto, Bitcoin shoot up, but this isn't a banking crisis.
It's I don't agree with it being good for Bitcoin. I think it's truly a non-event for Bitcoin stocks in general. But something when this kind of thing happens, this is the way I look at the market. Others may disagree, but for me, when there's an event that happens and it fully retraces on the same day across assets, it's a non-event. It doesn't come back the day after or the week after. It's done. Market processed it and moved on. One more thing is this thing, the downgrade did generate quite a bit of panic in crypto circles, which we could observe last night. And it's I think it's an interesting phenomenon that actually it talks about how basically positioning in crypto is TradFi is in Bitcoin and crypto natives are in altcoins mostly. So as soon as they start rolling over, people get very, very uncomfortable. In the meantime, Bitcoin barely, it didn't really matter that much if you think about it.
Yeah, overall, I agree. I mean, it's like a buy the rumor, sell the news event as it relates to bonds. My view is that you're closer to the high in yields rather than the low in yields. You still are seeing, some slowdown in economic activity. We haven't felt the effects of tariff. Real income growth rates are slowing versus inflation. So I think you're probably seeing it at the high, but it is notable that Bitcoin is at this key technical level, and it's a make or break technical level. And if you look at U.S. equities too, they're also similarly, they've had a 22% plus run off the bottom, which is the median run that you get off of a correction of that depth where the VIX achieved the level it had. And where we go from here will be very telling. I would not be surprised to expect some consolidation this week. It'd be natural, it'd be very healthy.
There is an argument to be made that the run we saw in Bitcoin yesterday has nothing at all to do with the Moody's downgrade, just from the timing. It started right when Scott Bessent was on the CNN Meet the Nation show, and he said that we are going to be focusing on increasing GDP so the debt to GDP ratio improves. See, that did not send a message of austerity, and he didn't mention at all bringing the deficit down. So obviously the message was, we're going to keep on with this fiscal stimulus. And I think that is what pushed Bitcoin up yesterday. So it went up, came down, but we haven't yet seen the reaction
You're
from
right.
the downgrade.
You're right. I know. Go ahead.
I went to see my cardiologist on Friday, first time in a decade, and he actually thinks it would be healthier for me if Bitcoin goes up. To be honest, so, I'm sorry, Ron.
Healthier if it goes. I can imagine there's less stress, right? You're gonna get less cortisol and more dopamine in your bloodstream.
Yeah.
So Bessent, Noelle, to your point, he said, hey, we're going to outgrow debt through growth, which is a supply side answer, right? Now, I asked Grok, which I love. Grok is my favorite AI, indispensable now. But I asked Grok to do a side-by-side table of GDP growth versus debt growth. And this is what you see. It's very hard for GDP to outrun debt growth. If you want a strong GDP year, you've got to increase debt in the prior year. You got to have a lot of spending. That's what you see here in 2021. But all to say is, there's no fiscal austerity. It's spending. That's the spending will continue. In fact, if you look at the stocks of defense contractors, are back to all-time high. I remember there's some discussion a few months ago about Trump saying, "Hey, can we do a global peace deal and cut defense spending 50%?" You also had all these primes, for example, Booz Allen, Hamilton, Accenture, and others that have large government contracts. Their stocks were smashed, and they're recovering now. So, U.S. fiscal spending is back. Never stopped, really.
Well, never went away.
Never went away.
And the bill that they're currently debating, I mean, it did actually finally get through the committee last night, which again, extraordinary to be blocked in the rubber stamp committee. So that's again a sign that could have some a rocky path ahead. But it is quite astonishing in just how much it is going to be increasing, not just the deficit, but also the outstanding debt. And yet they're still talking about Doge doing its thing and bringing down spending.
Yeah, I mean, I want to go back to something that Ron brought up about how, like, Trump going after Walmart saying you can't, like, increase your prices and all this stuff. It's just like it reminds me of a lot. It's so funny because you see it in both political parties. They like to, like, defy that there's consequences to their actions, and Trump's like, just eat the losses. And the Democrats did stuff like this left and right under Biden. Like, this is not actually a negative consequence for these things. Like, whatever. It's just like it feels like the same exact playbook on that front. I just wanted to throw it in there because you brought it up real quick, Ron. Go
I was
ahead.
at Walmart this weekend. You know what you do when you get older on your birthday, you buy gifts for everyone else, food and drink for everyone else, like it's a reverse widow card. So I went to Walmart. By the way, it's a reminder this is like the eighth wonder of the world, and somehow it just got better from since the last time I was in Walmart. The selection, the variety, and this time when I was in Walmart, I was looking at it from that lens: is hey, can they pass prices on? So two fun facts. One is Walmart's net margin is 2.9%. Their gross margin is 30%, the difference between their fixed costs and overhead and all the rest. My conclusion from this is Walmart will have no problem passing prices to consumers. In fact, you're not even going to notice it. If they're board games, you can get there, like the monopolies of the world, like $12.50. If that goes to 15, no one's going to notice. It's not going to make a difference. So from a retail merchandise perspective, I'm not really that concerned. I'm more focused on what tariffs mean for semiconductors, because you've got hyperscalers spending hundreds of billions of dollars over the next few years on semiconductor chips. And if you want to maintain a leading dominant role in AI from a national security perspective, which is what Trump admin policy wants, I think is a good policy. How do you square that with tariffs on semiconductors? Do you make the tariff level higher or lower because they're strategic to national security? I'd argue lower, but
At the same time, you want to incentivize domestic production.
yes.
Easier said than done, I guess. A lot of countries
Dollar
do that.
General, Dollar Tree, all those stocks have been rallying, by the way, because they, if you're going to buy a product for $1 from these stores, you got to import from China. So they've been benefiting from this.
A little bit off topic, but I mean, one of the points of having the biggest military by a very large margin in the world is that you can have your production wherever you want because you have the military. You can take control and protect anything. So it's I always think that this view that you need to make in America for America, the U.S. to be stronger, it's misplaced. It's mostly a narrative for boats. It's not necessary.
I used to have that view too, and I still do. Like, the United States has 11 aircraft carrier, we can project force, etc. Our defense spending versus Europe and the world combined, it's like we're still the leader. But then these Houthis, what's up with the Houthis? We've lost F-18 fell off a carrier. Allegedly, some other F-18s were, they're not in commission. And we did like a deal with the Houthis. Like what's going on here? What's the relevance?
Carriers are expensive. Drones aren't.
Right. Like the American military force is not modern for the threats that we see, to Noelle, to your point. And
which is interesting. It's interesting when you step back and remember that for years we've been told that what protects the status of the dollar, the U.S. military.
The Houthis, it's embarrassing to see that the U.S. had to cut a deal with the Houthis against the desires and interests of Saudi Arabia and Israel, by the way.
Yeah. And then again, there's also some doubts whether that is indeed what happened. Did they cut a deal with the Houthis? The Houthis are not convinced of this, it seems.
Is that right? Apparently, the article I had read was that the United States is spending $1 billion a month combating the Houthis for limited material progress. $1 billion a month is actually nothing by the U.S. defense, but it's like absolutely nothing. It's nothing.
Billion here, billion there. Yeah.
mean, I'm all for like cutting expenses and all the rest, but
Yeah.
I was just surprised by.
But it does feed into the outlook for the dollar, which we touched on earlier, which is relevant to the downgrade. The dollar is not the safe haven it used to be. When Fitch downgraded in 23, US yields went down because although the US government debt was downgraded, people rushed into it as a safe haven. And that is not something we're seeing this time. There are other safe havens. Gold rallied on the news. Gold seems to be continuing to do quite well today. Bitcoin still has its dual narrative struggle going on.
Do you guys have any strong views, and has anything changed in your views over the last few weeks on inflation, where rates are going, or any of that?
Everything's changed.
I'm becoming more convinced we're not going to see rate cuts this year.
I agree with that. I mean, maybe in the last quarter, but certainly nothing imminent.
I think we'll see cuts maybe last quarter. I don't think it matters that much unless you buy into that
agree.
liquidity is everything narrative, which is very flawed. It's what matters is growth and earnings mainly in
Yeah.
this market.
And yield curve control. I mean, we know that they have to bring yields down. Yields are not going to come down naturally, especially if inflation expectations remain high, as does uncertainty. So some kind of yield curve control we're likely to see by the fourth quarter, because otherwise the deficit situation is just going to get untenable. Interest is a greater percentage of the deficit now than of spending, than defense. That is going to continue as they issue more debt and the yields continue to go up. And that's not productive spending. So they're going to have to come up with some way to massage the yields down one way or another.
So I would say that the views all shared here, I would describe as consensus views. I think we'd all agree they're consensus too. The point being, though, that what creates surprise to markets, what moves pricing, will be something non-consensus. And I think that view, and I actually have this view, is that you will get a bout of stagflation over the summer when the tariff policy after 90 days is there. And I believe the floor on tariffs will be 10%. You saw that in the UK deal, where we raised our sales taxes, e.g. tariffs, and UK lowered theirs, and that's an ally. That's going to be a template for what a good deal looks like. So that will create a bout of inflation over the summer, but I think it'll be digested. It'll get worked through. The other thing that often happens in June, July, August is you get some seasonal weakness in initial claims and employment. It happened last summer, happened the summer before that. Last summer it caused a growth scare, fear. And right now, markets aren't priced for that. Markets right now are priced for the consensus story, which was just shared.
One thing I've been thinking about a lot recently is, we pretty much agree on that rates cuts are going to be pushed back, if at all, and that the outlook for crypto is positive medium term. But what if we're wrong? Rather than ask what if we're wrong, we're wrong. Why were we wrong? Now, come at it from a different point of view. How could we be wrong here? Let's go anti-consensus.
Yeah, I mean, just to throw in some data here, we were just a week ago, 2 weeks ago, we were pricing for a cut pretty heavily, a possibility of June, and a very high probability of a cut by July. We've pushed that out to the September meeting. I think something's gonna. I think we're still gonna get another cut or two. I think Trump's gonna get what he wants instead of a cut. So right now we're basically pricing for one cut by September, and then pricing for another two cuts before the end of December. So before the end of the year, and then the third cut is expected to come sometime in January or March. That's what the markets are saying right now. I'll go against you guys saying you don't know if there's going to be a cut this year. I think we see a cut this year, and I think it happens in September at the latest.
Well, I would say a good non-consensus angle on this, by the way, James, I think that kind of squares with how I see things too, but is Renaissance Macro and Neil Dutta. And he was very kind of bearish in summer of last year and anticipated these rate cuts. I disagree with those rate cuts, and employment data has been nothing but strong, and corporate earnings have been strong. But that kind of doesn't matter if you're in the policy view and you've got to make a decision. But he has a recession call out there. and he's citing weaker government hiring, including at the state and local level. There's also data around tax receipts, and tax receipts are not a real-time variable. It's like a near-time variable, and the tax receipt data is weakening. And if you look at real income versus inflation, your real income is declining below inflation, which is not a good picture. Housing data remains weak, and housing is a big driver of the economy, of course. But like we're seeing inventory backlogs build, right? The mortgage rates are elevated right now. I don't think they can go much higher than here, but they're still elevated. So that's the summer story that I think plays out maybe end of June, somewhere through July, August, September. And you have 21 times earnings on the S&P again. So you can't really go from 21 to 22. You need a lot of trust and forward-looking clarity to get higher than that. I just don't see that happening. So, I think S&P at 6,000 is close to fair value. We're at fair value like right around now-ish, right? Still bullish between now and year end, but I think you're fairly priced versus that alternative story, which I think will start to come into the foreground.
But you're assuming that we're not going to be any significant EPS forecast reductions, which if indeed we do see the bite from tariffs and we do see the employment slowdown, then we will. I've been, again, coming at it from the other way. It's December, imagining here. It's cold outside. We've had 3 cuts. Why have we had 3 cuts? And the only thing I think that would trigger that kind of thing is if things are really bad out there. If unemployment is shooting up, sure, that would make them, that's within the Fed's reaction function. Or if the Treasury market has totally seized up and they have to do something, and let's face it, the symbolic lowering of rates would be part of that. And also another question to throw out there is, why do we think the Fed would only do a 25 basis point cut if it's going to do one? As Alex says, that would do absolutely nothing at all. That's like swatting a fly off of a hippo.
Yeah,
it would, if it's going to move, it would probably move big to send a message that the market would actually notice.
But they did adjustment cuts in Q4 of this past year. Why wouldn't they do the same? Just managing the real rate of interest, which is what they look at. I don't think they should look at that, but they do look at that, right? So the real interest rates remain elevated. We should pull up a chart on that, but they are way too high. That's why the FOMC officials believe Fed policy is currently restrictive. I think they're wrong. I think the high real interest rate reflects strong underlying economic growth, and you're not going to get a recession. You're going to get labor hoarding. Consumer spending is still fine, but you do have the conditions for another summer growth scare. You could do adjustment cuts, Noelle, though, right? I mean, to your point, I think they could just do 2 or 3 adjustment cuts just as inflation comes down.
If inflation comes down.
Right. The summer could throw a curveball on that too. Alex, what do you think about that? Interesting to hear.
Well, a couple of things. The summer data, I don't think is going to be very important. I think the market is going to look through because with the pivot in tariffs, if it's maintained, which I don't see any reason to believe it won't be maintained, we have what they signal is that we have a very pragmatic administration capable of pivoting fast when things go wrong.
You don't think the 10% floor on tariffs will be maintained?
I think it will be maintained. I do think, and I think it's fine. I don't think it matters that much. It would matter if we were higher than that. So what I tried to say is that the growth scare is not going to scare anyone. And the other thing I think I wanted to point out is on the yield curve control. That's consensus in crypto only. It's not consensus outside of crypto. And it's actually something pushed by some large influencers in crypto who are wrong over 50% of the time.
That's not going to happen.
Not really in the ways.
If we see it, it would be extremely bullish because it's not priced in. And I don't think it's going to happen because we're very far away from an emergency situation where the U.S. has to take such an extraordinary measure. It would be extraordinary.
Well, not
Um,
that extraordinary. I mean, it's happened before in history, and it certainly happened around the world. I mean, we are becoming, in terms of the debt policy, more and more like Japan. So I hear people suggesting this in the macro newsletters I read. I haven't heard it that much in the crypto circles. And you're totally right. Crypto people tend to not fully understand Fed policy, and they tend to see what they want to see there. So I I wouldn't consider myself a crypto native at all, but I do think that this is what we're going to see because I don't think there's any alternative. And I do think that we're going to be taking a page out of Japan's playbook when it comes to that. Maybe we won't even notice it's happening. I mean, there's a runoff naturally, anyways. We just might see that tilt in a certain direction.
Yeah, it's true. This is mini Japan. So check out this chart here. Saw this from the BAML Flow Show report, but it shows a summary of the quote big beautiful bill, and you can see some of the savings and cost components. So a big cost line item in the budget is extending the Trump 1.0 tax cuts. Okay, now that's not incremental, that's a continuation. Uh, that stimulates for people that had concerns about tax cuts going away. I don't think it stimulates that much though, because it is current state of affairs. Then you've got new tax cuts, which is $700 billion. However, you've got these tariffs on the bottom left. They call that savings or revenue. Those are sales taxes. Those sales taxes will be borne by corporates and small businesses. Now, if you're a small business owner, it'll be, and consumers, yes. Thank you. Correct. It'll be some split across the provider of service and the consumer. For the small businesses, those tariffs will be felt like an increase to their marginal tax rate. Right? If you import from China, Vietnam, and you sell that hockey stick or on Shopify or whatever it is, furniture, your marginal tax rate's effectively going up. The sub 150K population is likely to get a tax cut. So it's actually a kind of redistribution, right? So high income earners, shareholders in big corporates, and then small business owners, they're going to get a tax hike that funds a tax cut for sub 150K, which is, it's a populist economic policy. I'm not for that policy, by the way. I think if you're benefiting from services of the state and federal government, you should have some stake in the system. You should pay taxes, even if it's small. You should have some stake in that, so you feel some accountability towards your elected officials to maintain some kind of cost discipline.
Yeah, I mean, it's just crazy. Like, I mean, on there was like $2.7 trillion deficit added, and it's just like, I thought we weren't doing that. I thought the whole point of this was we weren't going to do this anymore, and here we are.
It's like a 34% increase, which is not trivial.
It's going to be great for year-over-year corporate earnings growth, by the way. So I'm bullish on this as
Yep.
an
It's good for
investor,
markets, for sure. Definitely good for markets.
as a
And this is a way that yield curve control can come in the back door. We don't even notice. I mean, we assume that by yield curve control, and this is perhaps why Alex thinks that that it's largely in the crypto native sector, that the Fed's going to come in and just buy up the bonds. That's not the only way to do yield control. Another way, which I think we're going to see, is changing bank regulations, so changing the capital rules and encouraging banks to buy 10 years or 20 years. And, by the way, you'll get some tax rebates if you do. For instance, and again, bullish for crypto.
Well, you're right on. I mean, that's going to happen. Now, Bank of America did this, of course, right? Bank of America was buying 1.5% 10-year bonds on their balance sheet, and now they've got $100 billion hold to maturity loss because of that. But yeah, the regulation will waive the supplemental leverage rule, make it easier for banks to buy bonds. But is that really in the best interest of banks to own bonds from the quality of their balance sheet?
Not necessarily, but that's not the priority.
I was going to say two things. Ron, you were talking about the housing market. The housing market nationally is correcting. Like, it's coming back from the hotness of COVID, but it's very regional. I mean, Texas and Florida, where a lot of people move for multiple reasons, insurance, other things like that, just got too hot. They were getting hit the hardest. But like up in the Northeast, New Jersey, New York, Connecticut, like it's still a very, very, very tight, hot housing market right now, and it's actually going the opposite direction for the rest of the nation, which is fascinating to me. I mean, obviously, I'm not a real estate analyst, but I like watching this stuff because I find it so fascinating. The other thing I'd say, we were talking about unemployment and stuff. One thing that shout out to Anna Wong, the Bloomberg economist, like she's been talking about this, like the amount of time that people are taking to find new jobs has extended a lot. So we're not seeing like a tick up in unemployment, but we are seeing some weakness. And I think Neil Dutta at Renmac has talked about this as well. There is a bit of a decent amount of softening in the employment market. So I think that's another area where that I know we should be watching. I don't know if we'll see hoarding. And the last thing I wanted to say that I've heard multiple people talking about, Josh Brown over at Rootholtz and some other people. One of the unique things about the stock market might be that these top high flying big names in equities might be not as like risk, like we're not in a consumer cyclical environment anymore. Like when you have, even if we go into like a minor recession, like some people are calling for in the next year or two, like it might be that the biggest names of the S&P 500 hold up better than the vast majority of other names. Like it used to be, manufacturers and all these companies that were subject to the cycle. But like, if you go into a recession, are you really going to like get rid of your $20 Netflix subscription? Are you going to really stop paying a couple dollars for added, you know, uh, memory from your Google Cloud and all these things? Like these are things that are kind of just embedded. Like you're going to stop going out to dinner maybe, or stop doing other things more likely than you're going to, stop spending money at the Mag 7 type names. Obviously that's not true for all of them, but we could be at a point where like these bigger stocks, massive earnings, decent earnings growth might actually hold up better than a lot of the smaller cap stocks and mid cap stocks, the things that you would normally think like the high flying growth names get hit the hardest, but that might not be the case in the next potential recession.
The consumption basket has to shift though. If real incomes aren't keeping up with inflation, there's got to be some shift. I agree with your point on like these consumer staples, essentially some of these tech companies. I'll share an anecdote with you. So when I was in upstate New York this weekend, I had dinner with a friend. He's a general manager of a factory that manufactures Kevlar vests and other equipment for the US military. Small town, upstate New York, local manufacturing, and they import silver from overseas, okay? I said, what are the challenges you have in your business? And he said, we can't hire people. We can't get jobs. I said, what do you mean? Like upstate New York is suffering from higher unemployment than New York State. It's a well-known issue. He said, no. What people do is they sign up, they get the job, and they don't show up the second day of work. They wait for us to terminate them. Then they go on unemployment benefits and the cycle repeats. And the wage for New York State, I don't know what the minimum wage is. Maybe it's 18 or 20, somewhere around there, but it's much higher than say like South Carolina. So that's another dynamic here. So to your point, James, on, people are looking for work longer. No, if you want to qualify for unemployment benefit, you got to raise your hand and say, hey, look, I was looking for work, therefore I qualify for unemployment benefits. I just couldn't find it. And it goes back to like helping Main Street. This is Main Street. That's an aspect of Main Street. Like I'm all for small business Main Street, like entrepreneurs. That's an entrepreneur. He can't get the labor he wants due to policy that's counterproductive, and taxpayers are funding that. And that's inflationary, right? Like that, by the way, that's like a quasi form of universal basic income. New York State, essentially you've got a basic introduction to universal basic income, and it's not helping the economy. They're people that are just kind of living, not working, and rotating from the benefit to the next. They get the job, then rotate to the next.
Gaming the system. I mean, I heard about that being anecdotally from other people being a much bigger problem a couple of years ago. The people that I talked to that were having that problem, including like my mother, she works at a doctor's office, and they had like the same issue. People would come in and then basically not do the work, and like they were fine with getting fired because they would just collect unemployment. So, but that hasn't been the case from the other people I talked to.
It started with COVID, but that funny thing, the second person I had over dinner was actually a doctor who shared that exactly what you just said. But it's a post-COVID phenomena, right? It's a post-COVID behavior change. Now, it's still not at those levels, but there is this residual effect.
All right. I think that's good on macro and stuff. Does anyone else have anything on macro before we move to crypto?
Quickly, you guys mentioned housing. Just wanted to say, like, I had a podcast last week on macro with one of these crypto podcasts, and one of the guests basically had this extremely gloomy outlook about how the U.S. is going to implode in Q4 and onwards because of the housing market. And had these charts which basically point out what you guys were talking about. Actually, the demand in housing, it's a weakening market, right? There's a lot of people are actually moving away from buying to renting. There's quite a few metrics that show there is a weakened market. However, the balance sheets of U.S. households are very strong. So the housing market can continue going south for a very long time. It doesn't mean we're gonna see, and we will not see. I would sign that with blood. A replay of 2008. The housing market is not what defines the economy going forward in the U.S. It's when I worry about things, worry about tariffs, worry about hyperscalers, investments, and maybe layoffs happening. Worry about yields going above now, like the 10 years at 4.5, the 10-year going to 5%. Anything above 4.7, 4.8 is reason to be concerned. We're not there yet, but there are many things that you can be worried about if you want to, which is what we do in Macroland. We find things to be worried about. Housing market, I don't think, is one of them.
Especially if yields come down.
Fair enough. I agree. And I think yields, it's hard to see yields going higher. But Alex, what would you say is priced in? I think it's less helpful to say what will happen in macro because markets are perpetually discounting the future. By the time you arrive at the summer, you're looking at the fall. And it's more interesting to say what's priced in relative to expectations. I think you've got close to Goldilocks priced in. I would say, like discretionary names and tech has run up quite a bit. They probably take a breather here, and like defensives and healthcare and rate sensitive names, even like real estate names, maybe start to rally. But seems to me at 21 times earnings, wouldn't you say that you're back at pricing in Goldilocks as a base case?
It's what you said, is fairly priced. That means that we can run up a lot higher. It's fairly priced. And we have, in the meantime, we have carrots. It's like Trump is a purveyor of carrots right now. It's like these deals are not yet done. We have an extra 50 days of carrot land. He's going to give us deals. And then we have the taxes, the fiscal package. I think things are fairly priced right now. Sentiment, I've been looking at a bazillion sentiment metrics and positioning metrics, too many to single anyone out. The positioning, from what I see, I would say is slightly underweight risk, which usually means we continue higher if things something bad happens, something very bad happens, not Moody's, right?
Yeah, I think the multiples you're talking about is one reason. Another reason for potentially maybe not a recession, but like more like a flatlined market or not a massive up market like we've been used to the last couple of years, because things are priced, like you said, they're fairly valued or at least priced to like things going really well. And then I know before I pass it over to Ram, I do want to say something else in the housing market, because something I've noticed, I think somebody should do the study about all these people who are super bearish in the housing market, big names, and where they live. Like if they live in Florida or they live in Texas or they live in California in certain areas where like Airbnbs were huge and the market got really hot, like people kind of like they do this thing where they like this is the whole like national housing market, and can't be like, well, yeah, there's a bubble in this like regional market or this city or what have you, and they can't like grasp that maybe like it's just that area, which is likely to happen. Doesn't mean it's national housing market. The other point I want to make is you were talking more people are renting than buying. Somebody who's moving, like there are the rent versus buy scenario right now is so broken, and it's not a problem for many people as long as they still have a job, because they have a 30-year fixed rate. We're not like other countries around the world where you have to your payment goes up as rates went up and inflation goes up. Like maybe your taxes and insurance are going up, but for the most part, your mortgage payment is flat. And I'm looking at stuff, and if you were to buy like the same house, even after you do a 20% down payment, your monthly payment is equivalent to potentially higher than the rent in the areas that I'm looking. So like it's like, all right, you have to pay all these fees to buy a house, you were 20% down payment, and then your monthly mortgage payment is higher than your rent. And it's like, okay, I'm just gonna rent the equivalent condo or house or whatever. I'm not gonna buy. And until things settle, when either rates come down or prices of houses come down, I think that's just going to be the situation for the housing market, which I've heard a lot of people who haven't looked at this don't realize how like offside so many things are. And it's just because people are trapped in their homes. If you own a home, you're not giving up your 2.5%, 3% mortgage, and you're fine. It doesn't matter to you.
I just want to share this chart back to Alex's point of position. I do think this is one of the most critical variables in the market. So what this shows is the percentile of long short positioning for hedge funds. Hedge funds are marginal price setters in the market, right? You also have long only buyers. This is a theme we've been talking about the last several weeks. Last week, believed that the net exposure of a hedge fund was around 7%. In the backdrop of a market that's rallying 15 out of 18 days. And you can see on that right-hand side of the chart that their net exposure has increased off the lows, but it's still significantly below historical levels. So this is a performance chase. They have to invest. They have to buy. You see that today. You had Moody's downgrade. The S&P had a gap down open, and the indices covered and closed green. So hedge funds are covering shorts. They have to stay long. You can also see consumer staples were net sold this week. They're net sold because they're rotating out of this crouch position and buying Costco at 50 times, and they're buying anything else that gives them some more upside. So I agree. I think this is it's a critical kind of driver along with the VIX decay that's driving markets higher. I do think that at 21 times earnings, indices are actually close to fully valued, but then sectors within that are mispriced, and there's opportunity. That's why like healthcare is rallying right now. So I think you're going to get a natural rotation. Technology rally very quickly, discretionary rally quickly because there's no recession. I think they can still go some more, but these other sectors are going to benefit from rotation. Now we're seeing that happen now.
All right, let's move on to crypto because we're in pretty deep and we haven't done any of the bits part of Bits and Bips. So before we do that, let's hear from our sponsors who make the show possible.
Hi, it's Matt Hogan, the Chief Investment Officer for Bitwise Asset Management. Earlier this week, the U.S. Senate took a huge step forward towards passing stablecoin legislation. I think it's the biggest regulatory development to impact crypto since the approval of Bitcoin ETFs in January of 2024. To learn what it means for Ethereum, Solana, and other crypto assets, check out my CIO memo at bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
If you love the conversations we have here on Bits and Bips, you're going to love our brand new Bits and Bips newsletter. Our team will break down the key macro trends impacting crypto, the biggest market moves, and expert insights you won't find anywhere else. Whether it's the Fed, inflation, or major DAO proposals, if it affects crypto, we've got you covered. Best part, it's completely free. Stay ahead of the market and subscribe now at bitsandbips.beehive.com. That's bitsandbips.beehive.com. Find the link in the show notes.
All right. I guess I'll just start real quick with consensus because I was the only one there from the crew out in Toronto. Honestly, I had heard people were worried about a lot of people showing up. Also, anyone I know who lives in Canada that's involved in this space or launches part of the ETF industry, they were all there. So it was awesome to me because I cover the spaces, obviously. I think there was over 10,000 people there. I will say I went to Consensus in Austin in, I guess, 22 was the first one after COVID. And half the people there, half the booth there, I was like, I've never heard of like any of these projects. I don't know what is going on here. Talking to a lot of wacky people, but I will tell you the amount of people and clients and high quality panels that I sat on. Granted, I focused on the more things that I focused on, the DeFi and TradFi overlaps, those bridges, staking and ETFs, liquidity providers, all these different things. So I was focused on the areas that I covered more specifically. And I got to say, they put on a hell of an event. It was great. Toronto's awesome. Next year, they're going to be in Miami. So I'm very much looking forward. I prefer Miami to Toronto. But yeah, so I thought it was a great event. I don't really have anything like groundbreaking or anything that I thought was groundbreaking. Just overall, I thought it was extremely well done and looking forward to next year.
What were the vibes like? Were people optimistic, pessimistic? Were they focused on new token? Were they focused on venture funding, regulation? Like what was the talk of the town and the vibes?
Honestly, the vibes were good. They were positive. but all of the above was talked about. Regulation was a big topic. I mean, I did a panel. My panel was Andy Bear of CoinDesk Indices. He runs product for them. Anthony Scaramucci of Skybridge, who I'm assuming everybody here knows. We had Pascal from 3IQ. So he's one of the guys that launched the Sol staking ETF in Canada. So yeah, we had like a pretty damn good crew of different people there, talking about things from varying different angles. So yeah, and I forgot Jono Steinberg he's the CEO of Wisdom Tree. So that was my panel, but there was plenty of panels on all the things you talked about. And overall, I just thought everyone was optimistic. It didn't feel frothy. So I've been to these things like 2022 or 2021 where things really felt kind of frothy, you know? And this wasn't that. So I guess from that point of view, it's pretty good. Nothing seemed over the top or ridiculous. But yeah, vibes were positive. And to some people's dismay, I will say it felt a little bit more like towards a TradFi conference. Obviously, I go to those as well. So I've been to the stuff in 2022 where the vibes are really high. It feels like a club at times and things like that. This was not that. That was a little more institutionalized. And I think that was the goal of what CoinDesk is doing, to try to institutionalize the space, make it more available for institutionals and serious investors.
It's a great conference. First one I missed in several years.
Will you be? Well, Miami's next year, so it's a lot easier to get to. And for a lot of people, they got screwed with flights back to New York area, including me. So I know some people got their flights canceled and stuff. So if you're listening and that happened to you, sorry. So that's it for consensus. I don't really have a ton more to report. Let's move on to, I think the biggest news going on right now is what's going on with the stablecoin bill, the Genius Act. Coming into the last month or two, it's like Dems and Republicans they're on the same side here. We need to get some sort of stablecoin bill. Seems like plenty of Dems are on side with trying to get this through. There's still a whole group of them that are trying to stop it. And from what I can see is they're basically worried about KYC. I'm going to shout out Nick Carter here, former guest of the pod and friend of the pod. He basically said, like, from what I'm reading of the Democrats and what they're complaining about, obviously let's solve the first one. From my point of view, if cash were invented today, it would be illegal because they can't trace it. They can't track it. They don't know who's holding what. And that they're kind of like preventing digital cash from being able to occur. That's what they're worried about. From my point of view, what the Dems are doing. The second point of view, which I've been saying on this podcast since before Trump even launched his meme coin or right around then, was that we went from over here, everything was off. Then we swung the pendulum way too far to the right with the Trump family leaning in so hard into this space, which I guess is nice. It's positive. I'm happy they're looking into this, but it's like too much. It's like, even if they're not doing any sort of grifting, the kind of like way that you could see this and people could point to it as grifting and doing things that are not good for the environment and doing whatever, I think all of that, it's obvious the Dems are pointing to that as an excuse for why they don't want to do this, despite many of them admitting like this is a $250 billion plus industry and there's no regulation set up specifically for it. And here we are. I rambled there, but like, I think like I'm happy what the admin is doing with the space for the most part, but like I think more people in the space would be happy if they toned it back a little bit with what they're doing with Liberty Financial and the meme coin launches and all these other things. But yeah, you guys are nodding. I don't know. Alex, if you want to go first, I don't know. What are your thoughts on what's going on with the Genius Act? Stablecoin
don't have a strong opinion. I think it seems it's going to be passed. And there is one coin out there that is benefiting from it, but I'm not long enough, so I'm not going to share it. I'm sorry, guys.
Yeah, I hope. Yeah, let's hope it's passed, but I'm not so confident. There's a very strong. I mean, as we speak, I was just checking a moment ago. As we speak, Elizabeth Warren is on the floor rallying support against it, and her main objections are, as you pointed out, James, that Trump. There's no provision to prevent the Trump family from getting rich on the back of crypto. She's also very upset that there's no block of USDT being traded on US platforms. There's also, and this is actually interesting, specific mentions of the possibility of private companies creating stable coins, and X is specifically mentioned. This is something we're probably going to be hearing more about in coming months. And then, of course, the usual consumer safeguards. And she's getting support because her points are not invalid. I mean, she actually is making some reasonable points. She is, however, not seeing the bigger picture, and she is trying to stop progress in the name of protection. Unfortunately, She just may be successful. And if she's successful, that's really bad news because it will lose the momentum. And if even the low-hanging fruit, if even the easy thing to get through can't get through, then that is going to deflate expectations for further progress in regulation. It's fairly easy to say that it doesn't matter that much because we have a supportive SEC, but the SEC's rulings and attitude towards crypto is dependent on the administration. And what we really need is a bill that a change in administration can't overturn.
Yeah, I had a chat with Austin Campbell on this. Austin is probably one of the foremost experts on this, testifying in front of Congress. We got to get him here soon, by the way. Very thoughtful individual. And his view is, one, it'll get passed. Two is that the Treasury Secretary or the Treasury should broadly be supportive of this because of what it means for Treasury funding, an extra $250 billion in funding. Now, that's against like a $30 trillion Treasury market, but still it's a source of funding. He made this phenomenal point, though, which I thought was really insightful around China. He said, if you want to weaken China, which is a peer competitor of the United States, he said, stablecoins allow you to pay exporters in China in US dollar terms in stablecoin. So it allows those entrepreneurs in China to exit the system. I thought that was very clever because, what we're importing from China, it's not from the Chinese government. We're not importing bank financial services that are backed by China. They're entrepreneurs with businesses. And yes, some are closer to more state-owned, et cetera. But a lot of this merchandise, that can be moved. But I thought that was a powerful point. This is a no-brainer from a stablecoin national security perspective. Also, limiting payments to actors offshore like Tether, where you don't have as much oversight and control. So I'd expect that it gets passed.
Yeah, let's hope. It's important. Now, funny enough, to mention the stablecoins in China, the threat of dollar-backed stablecoins being more convenient than other digital payment methods is what is, on the surface anyway, driving the progress towards the digital euro, the EU CBDC that we're going to get announced and confirmed towards the end of this year. They are trying to figure out how they can combat the dollar taking over digital payments in Europe. They're forgetting that European digital payments largely run on US platforms anyway, specifically PayPal, Visa, MasterCard. And anyway, don't get me started on this because it is absolutely insane that they are still insisting that this is what Europeans want when the real story is they're afraid of the dollar influence.
Yeah, I mean, I just, the last comment on this I'll make is something that Noelle kind of hinted at. Like, if we can't even get a stablecoin bill, which even before and after Trump's election, it seemed like everyone was kind of like, yeah, we need to do this. Like, it needs to be done. If it's going to take forever for us to get this done, there's no way a market structure bill is going to get done. Like, this is a bad inclination for how long it's going to take to get that done, and then you have to wait till after midterms. God help us. I guess that's my view. So we might be just completely dependent on the CFTC and SEC rulemaking and just what they're going to do, and they're going to have to come up with their own guidelines, and we'll go from there, which is not ideal. It'd be much better if Congress would just actually give them some sort of mandate to handle this, in my personal opinion. Let's go on to Coinbase. Coinbase is joining the S&P 500. I don't have any strong views here. I'll pass it off to anyone else. If you guys have any strong views, good for them. Ram, what are your thoughts on Coinbase likely joining the S&P 500?
Well, it's what a round trip that was, right? When you had Gensler was coming in as the SEC chair a few days after Coinbase had listed. And so now it's a complete circle. It's a big congratulations to Coinbase. I used to work with Coinbase. They were my largest client when I was at Cross River. So I know they worked hard for this. Kind of amazing. I think the big questions now for Coinbase are, what do they do with USDC and Circle? Do they acquire the business or not? And how do they want to position against Robinhood? They want to go across asset classes, or do they prioritize payments? Do they deepen or they go wider? We have to, just see how that next journey unfolds.
Another question is, who's next of the crypto companies?
To join the S&P 500 or to go public?
To join the S&P 500.
I think we're going to see a bunch go public too, which
Yeah.
we should get into Circle after this, but I'll let
Yeah,
that.
but who among them would make it to the
That's
S&P
hard.
500?
It's hard. Very, very difficult to get.
MicroStrategy is a candidate, I imagine.
Strategy would potentially get in.
Sorry, strategy.
That would be the top signal. That's when you're supposed to sell, guys. When that happens.
Yeah.
I mean, ironically enough, I think to like some of these platforms that have like restricted owning of Bitcoin, I've talked to many of the people that are the gatekeepers at these platforms, allowing Bitcoin ETFs or Bitcoin exposure in themselves. Vanguard is a very notable one. You can't even use their brokerage to buy the Bitcoin ETFs. And it's funny because like you're getting Coinbase in there, MicroStrategy is in NASDAQ. We have every companies left and right. I feel like it's every day we get a new announcement of some company adding Bitcoin to the balance sheet or some new version of, the Bitcoin treasury company. It feels like a little toppy to me on that front as well, Ram. But I mean, maybe we're just getting started. But like we're at a point where like just your regular equity market exposure is going to have a decent amount of exposure to Bitcoin pricing. Obviously not U.S. large cap just yet, but we're heading there.
The big question for Coinbase also will be, they make the bulk of their revenue and earnings through net interest margin, through USDC. So how will that be valued going forward? I think that's a big question to ask. When you join the S&P, usually it's like a euphoric moment. And I was very excited about Coinbase. I was writing about it as much in 23 and 24 on Twitter. By the way, back then it was highly shorted and hated by a lot of hedge funds. And there was a big Twitter base that was buying Coinbase. And that's another theme we're seeing in the markets, by the way, of course, where retail investors were faster and outpaced hedge funds, and hedge funds just got squeezed. And same thing happened with Palantir. It's happening with Coinbase, happened with Jim Chanos shorting MicroStrategy for 3 years now, apparently. Did you guys see this over the weekend? No. He's selling MicroStrategy and buying Bitcoin. And he said, "Oh, I'm doing what Michael Saylor's doing. I'm selling MicroStrategy shares. I'm buying Bitcoin." Like, not quite the same, but yeah, I think Coinbase has some valuation challenges just where it is now, and we'll see how it does from here. I was a big fan of the stock the last few years. I don't know how I feel about it now.
I'll jump in here real quick. I was a little bit skeptical of Coinbase's stock price a couple of years ago, obviously blatantly wrong, mostly because I was looking there to get so much of their money with all net interest margins, which we need to talk about Circle next. But also their fees are so high. I was actually helping my boss because he's trying to get more and understand how some of this stuff works, and he could not get over the fact that like you're paying 1% in fees in some cases. If you do recurring buys, it's over 2%. They're just raking in cash, and that doesn't even include the spreads that they're taking money on. Not that like Coinbase is a great company, but like that has not been democratized. Like you look in the ETF world, like you are paying penny-wide spreads, and you are paying zero transaction fees or at least very minimal transaction fees. And that has not come to the crypto space at all. Even the places that say they have really low fees, not going to say any names, their spreads are pretty high. If you look at what the actual spot price of Bitcoin is and you go to buy them and they say no fee, the price you get executed at is not where the spot price is.
I agree. I'm using ETFs more.
Yeah.
Because of all the things you raised. Yeah.
On Coinbase, if you think about it, Coinbase is a clear example of the story Coinbase tells us is that it's a market that is extremely inefficient and ripe for disruption. Why? Because Coinbase is a horrible product and a horrible platform run horribly. They have absolutely the worst possible customer service. In a scale from 1 to 10, they rate at a 1. They're really bad. They just had this insane leak where they leaked 1% of everybody's information got stolen. 1% of all active traders, a very large number. They leaked everything, like your address, your name, your phone number, your bank
your
details,
last 4 digits of your social security,
your last digital socials. That for those who are not Americans, those are that number is sacred. They got your trading activity, all your trade. They got everything. And it on the news they dropped 4%, and the day after it bounced back 8%. So I don't know.
And Armstrong and Emily and Alicia, I mean, they're capable operators. Like what they've accomplished and built is serious, and they've got a lot of community around them too. I think the question for Coinbase also is like Robinhood. Robinhood is also founder led with Vlad, and their UX is compelling. It's cross asset class. You don't even need service. The funny thing, to Alex's point on Coinbase customer service, once a month I get a customer service call from Coinbase. Immediately, it's fraud. You're like, Coinbase is calling me. Okay, if I'm driving on the road, I'll try to entertain my kids by seeing how long I can drag out the conversation to protect them from the next unsuspecting person. But yeah, the service is weak. But Robinhood is executing, very well, and it's all about the attention of the consumer and where does the consumer live. I think a broader value proposition is compelling, and Robinhood is actually cheaper than Coinbase too. So
Yeah, this all goes back to the whole like bridging thing. It's Robinhood who is TradFi leaning into the DeFi side more so than pretty much any other, brokerage type platform. And we have Coinbase feeling the opposite way. They've launched a bunch of traditional futures contracts they've done that are CFTC regulated. They're trying to do tokenized stock. Like it's funny. Like we're going to see this like merging of different things. And I mean, obviously that's the area that I'm specifically focused on more so than anything else.
Just last quick thought on Robinhood. By the way, Robinhood now, and I owned it a few weeks ago, but I don't now. I mean, that thing is at 46 times forward earnings now. It's above the average analyst price targets too. I mean, it's expensive. So this whole, we talked about earlier, this high beta animal spirits momentum rally, that's happened. That's got to rotate now to other categories. So
you're saying I should sell my Robinhood stock? Because I was a big buyer of it the last few years.
No, we don't give any financial advice here, but look, taxes matter and time frame matters, and but it is, I admire the level of execution in the community that they've built. And the product. It's impressive what they've done.
Yeah, I want to point out one more thing before we start talking about the Circle deal. You mentioned UX and UI, Alex. You were saying it's a horrible product. Like I saw a tweet this weekend where like the Coinbase traders were celebrating that they ship 4-hour candles on Coinbase Advance.
Oh, amazing.
And that weekly and monthly are in the works. Yeah. And as somebody who works at Bloomberg, obviously, I have access to some of the best charting in the world. But I'm just this is insane. This is a nearly $100 billion company that's celebrating shipping a charting candle with 4 hours in it. And
we need to get someone from Coinbase on the show. We need to balance it now.
Yeah. I love the product. I'm technically a customer from back in 2017, and I would use it more if I were allowed to buy more than I'm currently restricted from buying. But there's some things they could definitely do to improve it, like lower the
They played an important role in shaping the industry response to Gary Gensler, though.
Yes.
Right. I think the industry owes a big credit to them, and they, financed Fair Shake Pack and a bunch of others, and they also rallied the troops, in that service. So that, credit owed for that.
Yeah. All right, let's get into Circle. We talked about the Ripple bid on the show before. It now seems to be, I don't know if you guys, how true the rumors are on this front, but it seems like, as you mentioned, Ram, a lot of their money comes from the differential between interest rates and getting free money on their stored in the USDC, because they basically have a massive profit sharing agreement with Circle. So I was I don't know why Coinbase isn't, if Ripple's offering this much money. I mean, Coinbase, there's so much synergies that are already basically partners. Coinbase makes more money from USDC than Circle almost in some ways. I don't, that might be an exaggeration of the numbers, but they're making a lot of money from their Circle partnership. So I don't know. What are your thoughts on Coinbase potentially acquiring Circle here?
Coinbase has them by the balls because they have a distribution agreement, right? That agreement has to be renewed at some term, and that's got to be disclosed as a material risk factor. The party that has more value in the relationship is the party that has distribution. That's Coinbase. You can swap out the back end. You can swap out the supplier funding even. Although USDC has an incredible brand, right? I mean, USDC is the brand. It is the token. Would I swap for another token that generated yield? Absolutely. And that's going to start happening. I would, the ability to have a digital dollar that accrues yield, that's non-custodial on chain, that's true innovation. That's innovation that is significant. So But is the USDC brand enough? I don't think so. I think you're going to see additional stable coins enter the market with people who can offer distinct value propositions competing on yield, for example, or the issuing bank and the brand and the counterparty risk of the issuing bank, etc.
I think all those tertiary things you were just mentioning matter, but like if you're able to get a 4% yield versus 0% yield, it doesn't matter. I mean, if we're talking 4 versus 4.1, like people aren't going to move, But if you're talking yield versus no yield, particularly in the US, like it's going to go to the yield, something like Athena or whatever have you. There's plenty of coins out there that are leaning into this space. But again, right now, I think it's more regulatory constrained than any sort of technical constraint. Like there's plenty of yield-bearing stablecoins out there. You just can't do it in the U.S. because one, it'll be considered a security, and two, there is no stablecoin legislation. Noelle, you look like you want to say something. Yeah, go ahead.
Well, from what I understand, and obviously I'm not a legal expert and I'm not American, but yield has various definitions. There are various ways it can be applied, and the Genius Stablecoin Act does prohibit the issuance of yield-bearing stablecoins in that the yield is part of the token or accrued to the token. But there is another way that I've seen some issuers do it, and that is just distribute the returns. That's a security essentially, but it's not. But it is a stablecoin that earns a yield, and it's not outside, if I understand correctly, of the scope of the proposed legislation. Correct me if I'm wrong.
Yeah, I think you're right. It's outside the scope right now. So yeah, I don't know.
So the point basically is that yield is not as simple as we think. There are ways around. I mean, security markets always find ways around any kind of limitation.
Where there's money to be made, somebody will
Yeah.
figure out how to do it.
Exactly, like nature, it'll find a way.
Yeah, it's like water flowing down with gravity. It's gonna figure it out. Go ahead, Rob.
Quickly on Circle, I haven't looked at a deal at all, but it's very hard to replace liquidity. There's a lot of pools and there's a lot of coins that trade against Circle. It's
Really
very
good
hard
point.
to I mean, Coinbase does not have the entire upper hand. That's what I'm trying to say.
That's a great point. Yeah.
Also, one thing we haven't yet seen in crypto, because it hasn't been big enough, but at the pace it's going, it could get there fast, is any antitrust move against a crypto company. And while, I think Coinbase obviously would be one of interest should they acquire Circle and make USDC the only stablecoin they use on the platform. That's just a hypothetical, but it's intriguing that we're getting to the stage when this could be an issue.
That would be interesting. And I would echo what Alex just said, because even in the ETF world, we look at things like assets and flows and trading volume. And like it's true in the ETF world, like liquidity begets liquidity. Like it becomes like its own ecosystem, its own solar system. So when something's at the center and there's a lot of things trading around it, it's just being used in multiple different ways. It tends to be used that way. It's part of the reason we have US dollar hegemony, because like if you're trying to get at different currencies around the world, like if everything is trading in dollars, it's much easier to go from like, the Thai baht into a dollar before you go to like the British pound's a bad example, but some other currency. So that's part of the reason why there's so much demand for US dollars, because everything is traded in dollars. So in the ETF world, which I guess we can get into, I'll give a quick update on ETFs if nobody else has anything to add. Liquidity is really hard to steal. So like we see people and ETFs launch and they take over and they'll pass on assets and take more flows from other things. But like SPY, it's not the biggest ETF in the world anymore, but by damn, if something goes wrong in the market and there needs to be liquidity, SPY is going to be the one that people go to trade, even if it's more costly and less efficient than newer products. So yeah.
Great point. Yeah, no, Alex, I think your
Alex.
point is on the liquidity pools. That's not easy to displace. This merger needs to happen. They'll both benefit from it. One can't live without the other. The impact of the economics is too much. Coinbase has an expensive valuation. They should pay with that currency. And then Circle, because it's private, has a funny money valuation. I don't mean that in a negative, disparaging way. It's just you're privately held. It's a funny valuation. It's not until you're publicly traded for a year that you really figure out what you're worth. So they should get this transaction done. It makes a lot of sense.
All right. Anything else before I give an update on ETFs and what I'm watching? I know most people don't really care anymore, so I guess it's good at the end, but maybe there'll be some alpha in here for people who really care. We've seen
We care, James. We care.
I care. This is my job, but I feel like it's not as critical anymore. I'm not moving the price of Bitcoin with my tweets about ETFs anymore. But yeah, so one of the big things people are asking about, Solana, XRP, ETFs, all of the above. Still, everything's just getting delayed. Cans are being kicked down the road for the most part right now. Anything that would hold spot crypto assets that would be new is being kicked down the road. Staking is a huge question right now. I think they're going to figure out a way to get staking done. The problem with staking in an ETF in the US is spot products in the US are in this wrapper called a grantor trust. We don't need to go in the specifics. It's just a legal structure. The problem is they technically can't really handle the yield. It would be what we would refer to as bad income. So there needs to be some input from the IRS. I
You
think the
said
SEC
bad income.
yeah, for lack of a better term. I'm not a
Explain
lawyer.
what is that?
It basically doesn't, it's an unqualified income, essentially. So like under the current rules, there's a lot of questions about what staking yield if you're taking in. So if you're an Ethereum grantor trust ETF and you get Ether back, there are issues with the way that should or would be taxed because grantor trusts are a pass-through entity and you're not just getting cash. So like there's a whole bunch of these concerns. So the IRS needs to chime in. Obviously the SEC and CFTC would likely need to chime in. So even if the SEC approves this, the question is like, is it going to be settled? So maybe the SEC, like I have all these thoughts. It's not really flushed out, but like in my mind, the SEC approves this. Could they be like, the issuers are like, well, we can't actually do this until the IRS comes in. And how long does it take the IRS to comment and give feedback on what the situation is? So that's a huge question mark at this point. I think the Solana ETFs are going to be approved even before staking is approved. So we could have Solana ETFs before we get staking. The one thing I would point out is the crypto index products that have been filed. So Grayscale's GDLC, Bitwise's BitW, and then also you have Franklin Templeton that has filed for some of this stuff, and Hashdex has a product that is out there right now that's just Bitcoin and Ethereum, but would be allowed to hold these other assets as they come due. The first one due is July 2nd. So when that happens, I think we'll see some approvals. And yeah, so I think it's possible that those things get through because they're less than 10 or 20% of the overall portfolios in these products that are not Bitcoin or Ethereum. It's possible the SEC comes out with some framework before then and like basically uses that early July deadline to approve other crypto assets. But yeah, so those are my views. There's a lot of questions still to be answered. I think we just saw some delays today. Things keep just getting kicked down the road. I don't know if anybody has questions.
It's understandable. They got a lot on their plate at the moment, and they're still trying to figure out how, the definitions. Hester Pierce gave a statement today. She was speaking at an SEC event. I haven't had a chance to go through the whole thing yet, but it's characteristically sharp and characteristically supportive. She pretty much says that she doesn't think most crypto tokens are securities, or rather, she thinks most crypto tokens are not securities, but the way that they are sold can be an investment contract. She also highlights how complex the kind of rulemaking is around crypto, precisely for many of the reasons that you highlighted, James. It's complex, but they're determined. She does say that crypto is not the most important thing that the SEC is looking at the moment, but she also highlights how significant and important it is to get this done because the lack of clarity around securities definitions is actually not just unique to the crypto asset class. The rules are vague. They always have been. That's partly by design, but with crypto, it's holding back an entire industry.
Well, it's really funny. You have this changing of the guard, and people are coming to similar conclusion that they won't be heavy-handed and just not helpful like Gary Gensler, but they're saying, hey, sometimes security, it depends. It's complicated. It reminds me of this. You guys hear about the news about the Epstein files where Kash Patel, the FBI director, and Don Bongino, now these are like hardcore MAGA Trump fans. They went out and they said, there's really nothing there. There's nothing there. It was like the biggest letdown ever. It's like, but you're supposed to be the other side. There's supposed to be something there. Like, no, there's nothing there. It was a suicide. It's all right. That's it. But they have a lot to do. I think I hope the SEC learns the right lessons. Like, why are they not prosecuting Richard Hart for fraud? Why? He is a bad guy. I'm not making a defamatory statement, blah, blah, blah.
That's insane, to be honest. The fact that they let him just like go like that, it's absolutely insane.
Right. They're learning the wrong lesson. Like, people in digital assets were happy to see SBF prosecuted for deceiving the public. They're happy to see Alex Mashinsky sentenced and go to jail. That creates confidence in markets and accountability. So why is that not happening with Richard Hart? Makes no sense. I feel like
This guy, sorry to interrupt, but this guy, he advertised very aggressively, literally a meme coin as a certificate of deposit. That's the sin. That's wrong.
yes, you cannot advertise banking services unless you are a bank. That's why Celsius was wrong as well. Yeah. So I think this is something that people outside digital assets don't understand. Like, people in digital assets actually care about law and order. That's what smart contracts are. They're immutable forms of governance.
Yeah, I mean, crime is legal now, right? Isn't that what everyone online is saying?
If it's in the code.
Yeah. All right, we went over as usual. Anyone else have anything to add before we wrap up? Alex?
Yeah, just quick one. Somebody asked a while ago, what do you guys think is best positioning right now? That's a very loaded question. That goes into financial advice, because at the same time, it really is dependent on risk aversion and basically prior positioning, etc. There's so many questions to answer that, but it's not because it's a crypto podcast. If I had to pick one asset to deploy right now, it'd be Bitcoin. Right now,
My opinion, I wouldn't disagree with Alex. I think it's a compelling story. You're going to find out very quickly on Bitcoin, especially just where it is technically right now, which is great. The second thing I would say is that the miners should be under consideration. I'd love to see if anyone has a view that agrees or disagrees with that.
I'm seeing a lot of talk about basically Galaxy going after miners, inefficient miners, to turn them into redeployed towards AI. I think it's partially reflecting in the price. It's been doing very well, the Galaxy stock recently.
The CoreWeave follow through bid, right? So CoreWeave's up 100% since IPO. CoreWeave did a deal with CoreWeave Scientific, Core Scientific. To your point, those are the AI plays, these hybrid plays, and there's a spillover effect from that, I would argue. Noelle, what do you think?
Not something that I follow closely.
Over 10,000 of you this time. For those of you who are listening to this on the podcast feed or YouTube show later, we also appreciate you as well. Thanks for joining us for this episode of Bits and Bips. We'll be back in 1 week.
Actually, we're not recording next week because it's Memorial Day, right?
Oh, yeah, you're right. So we won't be back in 1 week. We'll be back in 2 weeks.
2 weeks.
Thanks, everyone.